All right, people, it's time to talk about what's making us go down. Because data shows that spot buyers are actually, retail spot buyers at least, are buying back up. So, why aren't we going back up? Let's actually look at some of the data from CoinGlass and other places. So, we are risking dropping down to 107 or less. However, the chart suggests that the sell-off is far from over. Data shows spot buyers accelerating their accumulation. So spot buyers are actually accumulating. And there's a lot of demand in the mid and even lower 100Ks. So Bitcoin sell-off intensified, but data shows spot buyers increasing their allocation size. The liquidation heat map suggests sell-off could extend to $107,000. Obviously, liquidation means contracts, and in this case, specifically perpetuals contracts. So Bitcoin fell to a 2-week low of 108,865 on Thursday, while an assortment of entities have shown interest in buying the range lows this week. Selling during the Asian trading session has chipped away at the gains occurred through each rebound rally in the US session. So Asia is one of the reasons that we are actually selling down. They're kind of following the US market, and since there's uncertainty in the US market, the Asian investors are selling down. The other reason is that there are traders that have stepped in to buy the intraday lows, but here's the thing. But liquidation liquidation heat map data from Hbar shows a liquidation cluster composed of leveraged long positions at the risk of absorption from 111 to 107. So we could easily liquidate down to below 107. Now, I still wouldn't worry. If you look at TradingView, the time I would really get worried is if we fall below $98,000. And we are still over $10,000 away from that, so I'm not really all that worried. Now, the 200 MA and the 50 MA is good to watch. And the middle point between those is around almost to where we are right now. So we need to actually stay above 108, 109 to actually be really healthy. And to really get rid of this dip, we need to go above 115. But here's another thing, and this is this relates to a lot of the cryptos we talk about, the perpetual futures markets. In addition to the downside liquidation risk, activity in perps futures markets continues to drive Bitcoin's day-to-day price action. And I think this will be true, even more true in the future, because, every perps index is trying to outdo their competitor by offering more leverage. We know that Aster famously allows a 1001x, which is insane. Hyperliquid, I don't know how much Hyperliquid offers, but it's probably quite a lot. And Avantis, I think, for some assets offers 500x. So obviously you're swinging a lot of money at that point, and almost any semi-big person can actually affect the market at that point. But so perps indexes, you can thank Hyperliquid for starting it all, but you also have Avantis and Aster now. They're driving day-to-day action, and there's a lot of liquidations on those perps indexes. And there's going to be more to actually come. And there's also heavy selling from institutional size cohorts, which are between 1 and 10 million, continues to overwhelm the spot purchasing power seen among retail investor size, 100 to 1,000 orders. So basically, the institutional investors are more than canceling out the retail size investors. But perpetuals futures are kind of driving the markets downward, especially with their 500x and 1000x leverage, which I don't really know is reflected in the data yet. So despite Bitcoin nearly falling below 110K, the notable development of the day is the aggregate spot order book bid-ask ratio tilting towards buyers. So we're slowly on the way back up. I think we're slowly getting to a bottom, but I think 107, possibly 106 could be the absolute bottom, which would still be ultimately higher than the 98 bottom that we had a few months ago. The metric measures the relationship between the number of buy orders, bids, and the sell orders asked in an order book, and the ratio ranges between -1 and 1, with 0 showing an equal number of buy and sell orders in the order book. A bid-ask ratio that is greater than 0 indicates that there are more buy orders than sell orders, which means it's bullish. If there's more buy orders, there's more people wishing to buy up than to sell down, which could suggest that there's a greater demand for asset at the current price level. But it's not enough to offset institutional selling, and it's also not enough to offset definitely perpetuals. Setting the metric to 10% depth at only spot exchanges shows buyers beginning to step in as the price fell from 110. So there is heavy demand below 110, and that could ultimately save us and reverse this trend. a lot of people are buying from 110 to 111, but if they don't buy any higher, that could actually limit the upside. Proof aligned with this buying is visible in the anchored 4-hour cumulative volume data, where surge in buy volume is actually seen right here. While the spot volume pale in comparison to buying and selling seen across perps futures markets, perps have a lot more volume because they're leveraging super hard. The reemergence of a bid-ask ratio tilted towards bulls is first since it was last seen on September 5th through 7th, and that's when we went from 107.5 to 118. So in a week or two, we could actually go from where we are right now back up to about 120. Obviously, like the perps, I think the perps stuff is just like completely battering these runs because people take longs when things get happy, and then I think definitely there's big whales that trade against the majority and that actually liquidate them. And since no one's actually looking for this kind of manipulation, it kind of just goes unchecked. And I think a lot of the manipulation is actually done by the exchanges themselves. They have the most data and they have the most to actually work with to screw individual retail investors and get them liquidated. And I actually do think that's what's happening. And I've said this before, a 1000x perp trading platform is the perfect platform for whales to basically liquidate regular retail investors because, with Aster, you don't really know who's making the orders, but you can know what's going on with the overall order book, whether there's more shorts than longs, and kind of where they're actually gathered. So it is a manipulator's dream. So what are perps? So perps trading or perpetual futures trading allow traders to speculate on the future price of an asset, most commonly cryptocurrencies, without an expiration date. The derivative contracts use a funding rate mechanism to keep the contract's price tethered to real-time spot market price. Perps enable high leverage trading with a relatively small capital investment and are popular for their 24/7 accessibility. It's on blockchain, obviously. High liquidity and ability to hedge existing positions. So how perps trading works, perps are futures contracts that don't have an expiry date. So most futures contracts have an expiry date. Since these have an indefinite expiry date, you can just basically have them forever. But of course, you can easily get liquidated. And traditional futures have to be settled by a certain date, maybe 1 month, 3 months, 6 months. These perps can go on forever. Usually they don't last forever because people do actually get liquidated. Funding rate. To maintain the contract price close to the spot price, traders with long positions need to pay a fee to those with short positions and vice versa through the funding rate mechanism. This payment is typically exchanged periodically, often every 8 hours. Leverage. Traders can control a larger position with a smaller amount of initial capital, which magnifies both potential gains and losses. And I've seen people trade over 100x, even 500x. Hedging. Perps can be used as a risk management tool. For instance, if you hold a cryptocurrency, you can open a short position in its perps to offset potential losses from a short-term price decline. In perps trading, you're not buying or holding the actual asset. You are speculating on its price movements. So obviously, this is actually making crypto a lot more volatile, and that's going to continue in the time to come. It's not going to get more volatile. And most people don't really consider the risks. They don't consider capital depletion. High leverage can quickly deplete your capital if the market moves against your position, which is what happens to most people. Liquidation. If your losses become too significant, the platform may liquidate your position to prevent further losses, which I think is actually what's happening to a lot of people. And funding rate cost. The funding rate mechanism can become a significant cost over time, impacting overall profitability. So, obviously, this is going to really impact the crypto market, and they're becoming a bigger and bigger factor. They're not solely responsible, but while the claim that perps are solely responsible for bringing down crypto is an oversimplification, perpetual futures trading significantly contributes to the market's volatility and can amplify downturns. The use of extreme leverage in perps means traders can take on massive positions with little collateral, magnifying both potential gains and losses. So how perps affect crypto market volatility, massive liquidation events. When the price of a cryptocurrency falls, leveraged perp positions are automatically liquidated, creating a cascading effect. The forced selling of these large positions can trigger further price declines, creating a purge that drives the market down even further. Increased trading volume. Perps contracts now represent the majority of crypto derivatives trading volume, which can be several times larger than the underlying spot market. This means the futures activity can dominate the market and influence the price of the actual crypto asset. And generally, I think what's actually happening now is that the derivatives volume and the futures volume are definitely overshadowing the spot volume. We just read in that article that the spot volume is not able to counter the liquidations on the perpetual futures volume. And obviously, higher potential for market manipulation, the ability to hold massive leverage positions and operate across different exchanges creates more opportunities for market manipulation, especially for bigger players like Binance, maybe even Coinbase. But they're not the only factor, but I think in crypto, they're becoming a bigger and bigger factor of why prices move the way they do. So I would consider like obviously whale selling and institutional selling. I would consider spot market, but right now I think the big 900-pound gorilla in the room is perps, and more like institutional perps, because with the advent of Aster, where you can't really see who's actually making the bid, I mean that's just a gold haven for them to actually manipulate and make a lot of money off that manipulation. So people do need to be wary and do need to be careful of such things. And I definitely think that's beginning to dominate the market more and more. Think about it. If you're one of the big holders and you have a large stash of coins and you can just move the market, you see a bunch of 1000x leverages, which I know people do. All you have to do is move the market like 0.1% the other way, and you can liquidate all those people and make money. And I think that's why like all these exchanges are rushing to offer perps, because they are very profitable in like trading against their users. We also have Bitcoin long and short ratios. You can look at this at CoinGlass. If you look at exchanges, Bitcoin BTC long short ratio on spot, it's about even. I'm not really sure why BTC has mostly longs, but a lot of this is pretty even. Like, some are below 50, others are above 50. But if you look at the futures, longs versus shorts, you can tell that the majority of the future bids are still long. They're still kind of in the green. And that by itself is kind of a warning sign that there's a lot to actually be liquidated. And if they're actually like long, right, there's more longs than shorts to be liquidated, you are always risking yourself for whales to actually go in and liquidate all these long futures, depending on how much they're leveraged. And that could drop the price even more. And that's why like I agree that I think the price can actually drop to perhaps like the price could drop to like maybe 107, 106. By that time, I think like more people will be piling on shorts, and then the cycle kind of just repeats in reverse. So basically, that's where I'm looking at. The perps are really like starting to dominate the market. That leads the way to essentially the way to like bigger liquidations and more volatility. Even though Bitcoin has somewhat calmed down because of IBIT and other ETFs, I don't think that's going to be the case for altcoins. So if you want the high volatility and trading volume, you got to trade the altcoins. But I wouldn't take like massive leverage right now, because both ways, the whales are definitely liquidating and perps are starting to dominate the market more and more. So that's the news for today. Let me know what you think. Like and subscribe, hit that bell notifications button. Thank you and have a nice day.